Welcome to the deep dive. Today, we are strapping in and going straight into the heart of the latest corporate financials, specifically Oatly's Q3 2025 earnings report.
That's right.
We aren't here for the glossy slides or the big picture strategy. We're really cutting through the noise to find the financial signal.
Exactly. And for this deep dive, we're focusing exclusively on the core financial architecture. That's the prepared remarks from the CFO, Marie-José David, slides 23 through 30, I believe.
Right.
This section is really where the fiscal rubber meets the road. It's the essential analysis of cost, cash, and capital structure.
Our mission today is to really understand the proof points. We want to know not just what metrics improved, but how their aggressive push for financial discipline is fundamentally reshaping the business model.
Yeah.
For you, the listener, if you're looking for the quick read on the health of the company, this deep dive should be your shortcut.
And the context for this quarter is crucial. Q3 2025 is being hailed internally as, well, a profound inflection point. Marie-José David actually called it their best performance as a public company.
Wow, okay.
Yeah. That statement is based on finally hitting a key profitability marker that has, frankly, eluded them for years. That positive adjusted EBITDA number, that's the anchor for this whole narrative.
Okay, let's unpack those headlines then, starting with the top line on slide 23. Revenue growth reported at 7.1%, which seems like a decent figure, right? Especially now for a global consumer goods company.
It is, yeah.
Right.
But, as investors and financial observers, the very first thing we have to do when looking at any multinational's reported revenue is strip away the influence of currency.
Right.
The underlying or constant currency CC growth figure was quite a bit lower, 3.8%.
Okay, so that's a big gap. Here's where it gets really interesting for these global companies, isn't it? That 3.3 percentage point difference between the reported 7.1% and the operational 3.8% means foreign exchange acted as a massive tailwind. Essentially, a stronger dollar versus the euro and other currencies meant when they translated their international sales back, they got this, unearned bonus.
It's a crucial distinction. That 3.8% CC figure, that's the true measure of their commercial execution. How much product they actually moved and the prices they got, regardless of where they sold it.
So that's the operational health number.
Exactly.
Hey.
While the 7.1% is, what hits the bank account, the 3.8% tells you about the health of the core business. It's solid, definitely solid, but it's not the surging growth that headline number might imply at first glance.
Okay. Moving down the income statement then. Gross margin was basically flat year over year, coming in at 29.8%. Now, stability, even flatness, in this kind of volatile environment can often be a victory itself, right? But we'll come back to the battle fought to achieve that stability soon.
Yeah, definitely. That 29.8% is the result of a lot of competing forces pushing and pulling. But the profitability milestone, that's the real showstopper here. Positive adjusted EBITDA of $3.1 million.
That's the big one.
This is monumental because it represents an $8.2 million improvement compared to the same quarter last year. You're not talking about just marginal success here. You're talking about a fundamental shift in operating leverage.
We should probably pause on that term, adjusted EBITDA. For the listener, we know EBITDA is common, but adjusted means management is adding back or subtracting certain items they see as, non-recurring or non-operational.
Right.
Can we assume the bulk of that adjustment relates to non-cash items or maybe restructuring costs?
Precisely, yeah. In the context of a company like Oatly that's recently gone through significant restructuring, facility closures, high stock-based compensation, which is typical for growing companies, the adjusted figure usually pulls out those one-time costs or large non-cash expenses.
Okay.
Management uses adjusted EBITDA to basically say, look, if we run the core business sustainably, this is the cash performance we achieved. And that $8.2 million swing proves their cost reduction strategies and their newfound scale are actually working, regardless of accounting noise like depreciation or interest payments.
That successful swing really sets the tone. Now let's look at slide 24 and drill down into the mechanics of that 3.8% CC revenue growth. It wasn't exactly organic growth across the board, was it? It seems like it was driven by a pretty aggressive focus on volume.
Volume was absolutely the engine, yeah. Growing strongly by 6.6%. That demonstrates successful market penetration, consumer adoption. They're getting product moving through the channels.
Right.
Whether that's through new distribution points or, increased velocity existing ones. This is the goal of that refresh growth playbook the company's been talking about.
And this is a big but, those volume gains were kind of purchased at a strategic cost, weren't they? They were partially offset by a 2.8% decline in price mix.
Correct.
That's the critical metric to explore, I think. And frankly, it's where the financial strategy maybe gets a little risky.
It is a deliberate choice, though. When you see volume up and price mix down like that, it means one of two things, or maybe both. Either they're using pretty aggressive discounts and promotions to capture market share, or they're selling a higher proportion of lower margin products, maybe, larger format cartons, or focusing heavily on lower margin food service contracts versus those high margin retail specialty products.
Yeah, I see your point there. This balancing act is common in consumer packaged goods, CPG, but the question for the long-term listener, for you, is always, are they permanently sacrificing brand premium for short-term volume?
Exactly.
A continuous decline in price mix suggests that their product is maybe becoming commoditized, or at least they're competing more on price than brand distinction.
Absolutely. In a turnaround situation, driving adoption is often the first priority, just to get the facilities running efficiently. That's the volume game. But once you achieve that scale, the pressure immediately shifts to restoring the price mix. If this 2.8% decline persists quarter after quarter, it's a red flag. It could indicate they're stuck competing on cost against, say, house brands rather than selling the Oatly premium.
So for Q3, they prioritize scale.
Seems like it. But the clock is definitely ticking on restoring that pricing power.
Okay, so we established that the 29.8% gross margin was flat, but it was hiding this intense internal tug-of-war. Let's dive into slide 25 now and dissect the forces that kept that margin stable. Starting with the positive drivers, the margin tailwinds.
Okay, so we begin with the operational improvements. The first positive driver was absorption and efficiency. This provided a nice 60 basis point boost to the margin.
Right.
This is where that heavy lifting of restructuring really paid off.
And that 60 basis points, that's the return on some hard, probably painful decisions. Marie-Jose David specifically mentioned this benefit includes the positive impact from closing the Singapore manufacturing facility last December.
That facility closure is a perfect example of, financial discipline trumping maybe sentiment or inertia. While closing a plant involves significant upfront costs and likely job losses, there's a human cost. The financial benefit is immediate and tangible. Removing underperforming or just redundant capacity improves the whole network utilization and cuts fixed overhead right out of the cost of goods sold. That 60 basis points is the financial realization of that difficult strategic move.
Now, connecting back to the revenue side for a second, where price mix was down 2.8%, how did that translate into the gross margin calculation? Because you'd expect it to pull it down.
Interestingly, yeah, on the gross margin slide itself, pricing and product mix was overall neutral.
Neutral how?
Well, it means they managed to execute strategic mix management successfully in some regions. Specifically, they called out Europe and international, E&I, and also customer mix in North America enough to mitigate the overall pricing pressure.
Okay.
However, this positive effort was basically exactly neutralized by an unfavorable product mix over in Greater China. So, like you said, they were running hard just to stay in the same place on that line item.
So as soon as they kind of shored up the mix problem in Europe, a new one popped up in China, keeping the total line flat. It really emphasizes the complexity, doesn't it? Managing margins across three vastly different operational environments.
It really does.
And finally, the beneficial foreign exchange movement helped here too, right?
Yes. FX added another 30 basis points to the gross margin. Again, a favorable currency translation gives them a lift, but, this is an external factor, not an operational one. The real story is that internal battle.
Okay, let's pivot to the headwinds then, because these show where the vulnerabilities still lie and where that 29.8% stability came under the most severe pressure. The biggest negative impact was inflation pressure.
A significant 90 basis point hit.
Yeah.
This was primarily driven by higher labor costs within their European supply chain. Europe, especially Scandinavia, where many of their operations are based, has strong labor markets and in some cases, unionized wages. Absorbing a 90 basis point hit like that really speaks to the unforgiving nature of wage inflation that companies in that region are grappling with right now. It almost entirely wiped out the gain from the Singapore facility closure.
Wow. That puts the operational environment into sharp perspective. You close a plant for efficiency and you still end up basically behind because of rising wages somewhere else. What other operational issues cropped up?
Well, North America, which we know is struggling with revenue, created absorption headwinds. This is a really crucial technical concept for listeners to grasp.
Explain that a bit more.
Okay, think of it like a specialized machine shop, maybe. You design your factory, you build it out to run at, say, 100% capacity to ensure the fixed costs, the rent, The salaries of the core team, the machine maintenance are spread over the largest possible number of units.
Right, so the cost per unit goes down as your volume goes up, basic economies of scale.
Exactly. So when North American volumes dropped unexpectedly, mostly due to losing that large customer they mentioned, the fixed costs suddenly had to be absorbed by fewer units. This spikes the cost per unit pretty dramatically, which then pushes the overall gross margin down. That's an absorption headwind.
And it directly links that North American revenue problem to the overall company's margin pressure.
Got it. Precisely. And then there was one more thing, kind of an unexpected accounting adjustment. Higher than anticipated supplier penalties.
Supplier penalties, what was that about?
Maria Jose David clarified this was due to a true-up of accruals in Q3.
A true-up.
Yeah. So for you listening, a true-up basically means they realized their previous estimate or accrual for certain costs, in this case, penalties related to supplier contracts or maybe non-performance was too low. So they had to book the full corrected expense in Q3.
So it's kind of an artificial hit in this one quarter.
Often, yeah. The good news is that the CFO expects fewer supplier penalties in Q4, which implies Q3's margin took a sort of temporary accounting shock that hopefully won't recur.
So if you were to mentally adjust that 29.8% margin upward just slightly to account for that artificial true-up, the underlying performance might actually be marginally better than flat.
Potentially, yeah.
But overall, slide 25 really confirms the CFO's narrative, doesn't it? Achieving stability required surgical cuts and really tight cost management just to neutralize these massive inflationary and volume-driven headwinds. It's quite a stunning display of financial engineering, really.
It really is. They fought hard for that flat margin.
But let's transition now into how that operational discipline translated to the bottom line, specifically looking at the adjusted EBITDA improvement on slide 26. We know they improved by $8.2 million year over year. Where did that money actually come from?
It was almost perfectly split, interestingly. $4.3 million came from increased gross profit, which includes the scale and the margin management efforts we just discussed.
Okay.
The other half, $3.8 million, came from a pretty disciplined decrease in selling, general, and administrative SG&A and other operating costs.
Right, SG&A.
Yeah.
Usually the easiest place to cut, perhaps, but also the most visible sometimes in terms of marketing spend or staff reductions. That $3.8 million SG&A reduction reflects what Maria Jose David called creating a more fit-for-purpose cost structure.
That phrase, fit for purpose, it really signals maturity, I think. They aren't just doing emergency cuts anymore. They seem to be fundamentally rebuilding their operating platform to run leaner for the long haul.
Makes sense.
This includes those indirect procurement savings they cited earlier in the year, things like, renegotiating software licenses, travel budgets, non-production supplies, that kind of thing. And critically, these substantial reductions in SG&A managed to overcome the adverse impact of FX movements on overhead costs, resulting in a net win for cost control.
That's the hallmark of a company maturing out of its high-growth startup phase, isn't it? Realizing that every dollar spent on overhead needs to generate a tangible return, not just support expansion at any cost.
It's exactly right. This kind of operational pruning is the necessary precursor to sustained profitability. You just can't rely on constant high growth forever to bail out bloated overhead.
Okay. Now, let's drill down into the segment-level detail on slide 27, because this is where the volatility we mentioned earlier really gets crystallized. The company is only as strong as its weakest link, maybe, and here we see which links are pulling the weight and which aren't.
Yeah, the clear success story, the segment that continues to pull the profitability narrative forward, is Europe and International, or E&I. This segment delivered robust 8.4% volume growth.
Very strong.
Very strong. And the CFO highlighted that this validates the efficacy of their established growth playbook. It demonstrates consistent execution in those markets.
And what was the bottom line result of E&I's strong performance? How did it translate to profit?
A significant $9.5 million increase in segment-adjusted EBITDA.
Wow.
So E&I is generating the cash and the profit needed to fund the corporate infrastructure and, critically, to subsidize the restructuring efforts happening elsewhere.
So E&I is the engine right now.
It's the gold standard for the company right now, yes.
But the shadow over that success, unfortunately, remains North America. It continues to be the primary financial challenge. Revenue there declined by a painful 10.1%.
Yeah, and this decline is attributed mainly to the fallout from that large customer sourcing change they discussed in previous quarters. Essentially, losing a major retail partner or maybe a food service supplier created this vacuum that they just haven't managed to fill yet through new business wins.
This issue has been persistent for a while now. Given that 10.1% revenue drop and the resulting $4.5 million decline in segment adjusted EBITDA for North America, should the listeners start to treat North America as a long-term drag? Or are there signs of a new, maybe different turnaround plan there?
That's the critical question that these financials really force us to ask, isn't it? The mechanical effects of this decline are brutal. Lower revenue means less gross profit. And you combine that with those absorption headwinds we saw earlier, it just compounds the profitability challenge for that segment.
So what's the read-through?
Right now, the financial evidence suggests North America is maybe stabilizing, but at a lower, less profitable base. Management's narrative suggests they're working on it, obviously, but the numbers clearly show E&I is carrying the load.
Okay.
They seem to be, implicitly at least, focusing resources on E&I's success and maybe minimizing the bleeding in North America rather than initiating some massive, expensive new U.S. marketing blitz or something.
All right. Then we have Greater China, which threw a massive curveball this quarter. It posted this outsized constant currency revenue growth of 28.7%.
An incredible number.
Yeah, that would normally trigger extreme excitement, right?
It would, but Maria-Jose David was very, very quick to apply a massive and necessary caveat here. She attributed this spike explicitly to the timing of customer orders.
Ah, timing.
Yes, she issued a very clear warning to the market. Sales are not expected to be as strong in the fourth quarter.
Okay, this is classic financial expectation management. They're essentially saying, look, we had a great quarter because customers basically placed their usual 6 months of orders in 3 months, but please don't extrapolate this growth into Q4.
Exactly.
If an investor models Q4 based on that 28.7% spike, they're going to be severely disappointed. The CFO's clarity here is actually, a sign of good financial stewardship, ensuring transparency.
It really shows they understand their own numbers and the dynamics. If they hadn't mentioned the timing shift, the market might have assumed some massive acceleration in the Chinese market that simply isn't sustainable yet.
Right. And finally, the corporate segment. That showed an improved result too, $3 million better, due to those continuous efforts to drive out costs at the group level, the overhead stuff we talked about.
Correct.
So the overall picture from the segments is pretty clear. Definite success in E&I, deep structural cost-cutting at corporate, persistent structural challenges in North America, and all of it kind of masked by this volatile timing issue in China.
That sums it up well.
Now we move to segment 4, which is perhaps the most important for signaling long-term health. The control over cash flow and the overhaul of the balance sheet. This is where Maria-Jose David, I think, truly proved operational maturity.
I agree. On slide 28, the cash flow discipline is really evident. Free cash flow was a net cash outflow of $5 million for the quarter. Now, while that's still an outflow...
It's still negative, yeah.
It is, but it represents a remarkable $22 million improvement compared to Q3 of the prior year.
Improving a cash outflow by $22 million in a single quarter is not just small housekeeping. That's a profound operational win. It suggests they're getting really close to the point where the business can truly fund itself, even while absorbing necessary CapEx.
And the primary engine driving this cash flow improvement is working capital efficiency. Year to date, their working capital actually yielded a $20 million cash inflow.
That's huge. Working capital is the financial lifeblood, isn't it? It's the difference between what your customers owe you, what you owe your suppliers, and the cost of your inventory sitting on shelves.
Exactly. And when working capital creates a cash inflow like that, it means they're collecting receivables faster, holding less inventory, or maybe taking a bit longer strategically to pay suppliers. That's pure cash liberation from the operations.
And the ultimate benchmark of this efficiency is the cash conversion cycle, or CCC. Maria-Jose David highlighted that the CCC improved to below 40 days. And she specifically stated this is the best level since the IPO.
That's a major milestone.
Let's break down the CCC a bit, because for listeners maybe new to deep financial metrics, it's not just a number, it's really a measure of operational speed, right?
Yeah.
What exactly does a CCC below 40 days mean for a company moving physical product around the world?
Okay, so the cash conversion cycle measures how long a dollar is tied up in the operational process. So from paying for a raw oats, let's say, to actually collecting the cash from the customer for the finished oat milk carton. It's calculated as inventory days plus days sales outstanding. That's how long it takes to collect cash from customers, minus days payable outstanding, how long you take to pay your own suppliers. Hitting below 40 days means they're incredibly fast at turning inputs into cash.
And why is that so significant for a CPG company like this, relying on sometimes perishable goods and complex global supply chains?
Speed equals security and flexibility here. A short CCC means they don't have large amounts of capital just trapped, sitting idle in inventory or waiting in customer accounts receivable. This dramatically reduces their need for external, often high-cost financing just to fund daily operations.
Right.
It allows them to scale more quickly if needed, respond better to demand shifts, and generally weather economic instability because they're turning their raw materials back into cash within about 6 weeks. This metric is a real gold standard for demonstrating deep internal process control and, frankly, supply chain mastery.
That really reflects true operational maturity across the entire organization, not just in finance. Okay, now let's move to the capital structure overhaul on slide 29. These transactions were actually executed in early October, so technically post Q3, but the financial market impact is massive, and they wanted to talk about it.
Yeah, this is the CFO signaling long-term confidence and financial stability. They fundamentally reshaped their entire debt stack, moving away from maybe more restrictive or expensive debt towards a cleaner structure. First, they reduced their revolving credit facility, which is essentially like a corporate credit card, down to SEK $750 million.
And the CFO specifically said this reduced revolver was more appropriate for their asset-light strategy.
Precisely. They're explicitly stating they no longer need massive liquid lines of credit just sitting there because they're not planning large, sudden capital expenditures on things like new factories or other heavy assets. The focus is clearly on optimization, not expansion via brick and mortar.
So what replaced that previous structure? What's the new setup?
They executed two key moves. First, they issued SEK 1.7 billion in new Nordic bonds. These are typically cleaner, often longer-term debt instruments preferred by institutional investors in that region.
Okay.
And concurrently, they prepaid the remaining term Loan B, that's another type of loan.
Yeah.
And critically for equity holders, they repurchased and canceled a portion of their convertible notes.
Ah, the convertible note repurchase? That's a big one.
Yeah.
For the listener, why does repurchasing convertible notes specifically reduce potential dilution? What does that mean?
Okay, so convertible notes are basically debt instruments, but the holder has the option to convert them into company stock and to equity, usually if the stock price hits a certain level. This conversion, if it happens, creates new shares and thus dilutes the ownership stake of all the existing shareholders.
So it makes each existing share worth a smaller piece of the pie.
Exactly. By repurchasing these notes now, before they can be converted, the company effectively removes that future dilution risk from hanging over the stock. They repurchased enough to reduce potential dilution by approximately 40 million shares, which they said was about 10% lower exposure, equating to roughly 2 million ADSs, the way their stock trades in the U.S.
That is a clear, tangible move to strengthen shareholder value. It sends a message to the market, doesn't it? Like, we believe our current stock price is undervalued enough that using cash to reduce future share issuance is actually a smart investment for us.
Absolutely. It signals confidence in the stock's future, and it cleans up the cap table, making it simpler. And beyond just the dilution, the refinancing package overall resulted in expected annualized interest expense savings of approximately $5 million.
Wow.
That's a 7% reduction in their finance expense line on the P&L. That is pure profit flowing directly to the bottom line every single year moving forward.
The entire segment 4, covering cash flow and the balance sheet, really tells the story of an enterprise that has shifted focus dramatically. From chasing sometimes frenetic growth, often financed by messy, dilutive, or expensive debt, to prioritizing stability, capital efficiency, and clean, long-term financing. They've fundamentally de-risked the balance sheet here.
A very significant set of moves.
Okay, we've seen the internal controls improve significantly, but the external environment, as always, remains volatile. Let's look at slide 30, the final one from the CFO, where the company reaffirms its guidance for the full year 2025.
Right. Despite all that segmental volatility we saw in Q3, the E&I success, the North American drag, the China timing shift, they're standing by their main guidance metrics for the year. They reaffirmed the constant currency revenue forecast in that very modest range of approximately flat to plus 1%.
That's a very conservative forecast, isn't it? Especially considering they're currently running slightly above that year-to-date at 1.4% CC growth. Why guide for a slowdown in Q4 specifically?
This ties directly back to that timing issue in Greater China we discussed. The CFO is explicitly baking in lower Q4 performance because those customer orders got pulled into Q3.
Right.
So if you mentally adjust for that sales shift, the flat to 1% growth rate for the full year makes sense. It ensures the market isn't shocked when Q4 revenue growth kind of normalizes or even dips. The underlying narrative here is stability, maybe even caution, not a sudden growth explosion.
Okay. One piece of good news on the top line, however, came from the FX tailwinds update for the full year.
Yes. The estimated FX tailwind for the full year increased quite significantly. They raised the estimate from a prior 150 basis points up to approximately 250 basis points.
It's a full percentage point.
It is. A full percentage point of additional reported revenue just from favorable currency movements. This acts as a kind of buffer that helps them meet overall reported revenue targets, even if the underlying CC growth remains muted towards the lower end.
Got it. Now, for the profitability guidance, the adjusted EBITDA, they reaffirmed the range of positive $5 million to positive $15 million for the full year. That's still a pretty massive range, suggesting a wide degree of possible outcomes. But Marie-Jose David offered a crucial clarification here.
Yes, and this clarification is essential for anyone trying to model their performance. Based on Q3's performance and the Q4 outlook, specifically citing that China timing shift again, which means less revenue leverage, and also the non-recurrence of that Q3 supplier penalty true-up, which means less cost benefit perhaps than Q3. The company stated they are likely to be in the bottom half of that range.
Okay, so they are basically guiding the market toward the $5 million to maybe $10 million area for full-year adjusted EBITDA. That makes sense.
Yeah.
The cost relief from the Q3 supplier true-up not repeating will help Q4 margin maybe, but the lower expected revenue from China in Q4 will likely pressure the margin and scale efficiencies, kind of keeping them anchored near the lower end of that profitability forecast.
It's very surgical guidance, isn't it? They're not chasing the $15 million high end. That signals, I think, a realistic understanding of the persistent North American struggles and the normalizing growth in China. They're prioritizing hitting the target range, even if it's a low end, probably to establish credibility with the market after maybe some past misses.
Makes sense. And finally, capital expenditures. Still disciplined.
Yes. CapEx is maintained at approximately $20 million for the full year. This just reinforces that asset-light strategy we discussed during the capital overhaul segment. They're clearly not burning cash on unnecessary physical assets right now.
Okay.
And importantly, their guidance assumes continued external stability. So consistent economic conditions, consistent consumer behavior, and crucially, no direct impact from potential new U.S. tariffs. If significant tariffs were to materialize, that would instantly become a new absorption headwind and a new cost pressure, likely forcing a further guidance revision downwards.
So the overall outlook suggests internal controls are now robust, much improved, but they are still quite vulnerable to external pressures, forcing them to adopt a pretty cautious, almost defensive stance on growth for the near term.
That seems to be the picture, yes.
All right, we've reached the end of the CFO's financial architecture review from the Q3 earnings. The key narrative that Marie-Jose David delivered seems crystal clear. Fiscal discipline, not really organic growth acceleration at this point, is the primary driver of this turnaround story.
Absolutely. The company has demonstrated a really clear ability now to achieve and maintain internal control. They've managed the cost structure effectively. They've drastically improved working capital efficiency. Hitting that best cash conversion cycle since the IPO is a huge proof point. And they executed that major capital restructuring that reduces interest costs and future dilution risk.
This tells you, I think, that management has successfully fixed many of the internal operational processes that were maybe hemorrhaging cash and profit in previous years. They've proved they can control what they can control, despite navigating these intense external complexities like regional inflation, persistent price mix pressure, and of course, the ongoing drag from North America.
The internal structure looks sound now, much sounder. But the market execution, as we saw in the segments, is still pretty uneven. While the financial foundation is demonstrably stronger, the company's overall profitability is currently being heavily subsidized by that thriving E&I segment.
Which leads us nicely to our final provocative thought for you, the listener, to maybe explore further. The CFO's remarks really confirm the strategic shift away from a high-growth, high-spend startup model towards a focus on lean efficiency. So the question is, if the cost structure, the capital efficiency, and the cash management are now stellar, can that financial discipline alone sustain a global mission like Oatly's? Or does the success they're seeing in E&I need to be replicated swiftly, especially in turning around or right-sizing North America, to truly validate this newly efficient structure for the long term?
Yeah, that's the key question. The financial blueprint for survival and stability has clearly been laid out by the CFO here. You now have the metrics, particularly watching those segment-level EBITDA contributions and keeping an eye on that tight full-year guidance range to track whether this hard-won financial efficiency can actually translate into replicated, sustainable global growth in the quarters ahead, or if they remain a company heavily reliant on just one strong region.
we'll be watching closely. We'll catch you next time for more deep analysis of the financial architecture behind the headlines.